Illustration 11. Company X is contemplating the purchase of company Y. Okay, so there are two companies and X is going to purchase Y. Now, X has 3 lakh shares. So, shares, numbers, it is 3 lakh. And the market price of share is 30. While company Y has 2 lakh shares selling at 20 rupees per share. The EPS is also given. EPS is 4 of X and 2.25 of Y respectively. Now there are two alternative proposals for exchange of shares. There are two proposals. So in that, first proposal is in proportion to the relative earnings per share of two companies. The exchange ratio would be based on EPS. And the second proposal is 0.5 share of company X per 1. So the exchange ratio for another proposal is already given 0.5:1. What you are required to calculate? You are required to calculate the earnings per share after merger under two alternatives. So post-merger EPS is to be calculated. Post-merger EPS under this both proposals, and to show the impact, and both impact you need to show. Like pre-merger is this, post-merger we will calculate basis of this both exchange ratio, and then we will decide whether what is the impact and which one is the good proposal. Okay, so the exchange ratio first one is based on EPS. So target company exchange ratio would be target upon the acquiring company. So 2.25 divided by 4. It would be 0.5625. Okay, so this is the exchange ratio. Now post-merger EPS, how it's calculated? Earnings divided by number of shares. So what is the earning here? We need to calculate here. Earnings 3 lakh into 4, 12 lakh. Per share is 2.25 into 2 lakh is equal to 4,50,000. Okay, so post merger EPS would be total earnings upon X plus Y number of shares. Now total earnings is 12 lakh plus 4,50,000. The number of shares of X is 3 lakh, while when after merger the Y, the number of shares would be as per the exchange ratio. Number of shares is 2 lakh. 2 lakh into the exchange ratio is 0.5625 is equal to 112,500. It is 12 lakh plus 4 lakh, 16 lakh 50,000 divided by 412,500. What is the answer? 16 lakh 50,000 divided by 412,500 is equal to 4. See, always remember, if we need to calculate post merger EPS basis on the basis of exchange ratio is on the basis of EPS, then always pre-merger EPS and post-merger EPS would be same. Okay, so there will be no impact. Okay, now the question is, second alternative is 0.5:1. Same way, we will calculate the exchange ratio is already given. Post-merger EPS would be total earnings divided by X plus Y. Total earnings is 16 lakh 50,000. X is 3 lakh. Number of shares Y 2 lakh. As per this ratio, there would be only 1 lakh. 16 lakh 50,000 divided by 4 lakh. Answer is 4.125. Okay. Now the impact, if we need to calculate impact under both the proposals, pre is 4 of X and Y is 2.25 EPS. Okay, post EPS is 4 only of x. Y, how will we calculate? 4 into the exchange ratio is 0.5625. The shareholders of Y are holding only as per this exchange ratio, that is 0.5625. So the real post merger EPS is 4 into 0.5625 is equal to 4 into 0.5625 is equal to 2.25. So there would be no impact. So always remember, if EPS exchange ratio is calculated on EPS, then there would be no impact in pre and post. Okay, in the same way here, x and y, pre is 4 and 2.25, while we calculated the post is 4.125. Here the y shareholders in real are only having 0.5%, that is exchange ratio, and the ratio of 0.5 is 50%. 4.125 into 0.5 is equal to 2.0625. Earlier it was 4, after merger it would be 4.125. There would be an addition of 0.125 impact, and here earlier 2.25, now it's reducing. That means 2.25 minus 2.0625 equal to, there is a reduction of 0.1875 rupees. Okay, so if you are using the book of past edition, there is some error in the impact calculation. You may download the correct one, and you can get the correct answer in that study material. Illustration number 12. The following information is provided in relation to the acquiring firm Mark Limited and the target Mask Limited. Okay, currently they are saying the target is Mask Limited. Illustration number 12. Mark is there, Mask is going to acquire Mask. Okay, now earnings after tax 200 lakhs, Mask has 40 lakhs, shares numbers 20 lakhs, 10 lakhs, P ratio 10, 5. Fine. See, out of this data, what else you can calculate? You should calculate that. See, EPS could be calculated. Earnings divided by number of shares. One share earning would be 10 here. 40 divided by 10, 4. If P ratio is given, PE ratio is equal to MPS divided by E, that is EPS. Okay. So if EPS is there 10, P ratio is 10, what is MPS? MPS would be this multiplication, 100, 5 4s are 20. Okay, now you can also find market value. Try to solve all these basic requirements whenever you get such type of illustration. Try to get all the values which would be required in the further solution. Okay, now market value is MPS is already given, number of shares is there, so 20 into 100 it would be 2000 lakh. Here 10 into 20 it is 200 lakh market value. Now what is the first question? First question is, what is the swap ratio in terms of current market price? Current market price is 120. Swap ratio would be, swap ratio means the exchange ratio would be target upon acquiring is equal to 0.20. Second question is, what is the EPS of the Mark Limited after acquisition? Okay, as we are on second question, we need to understand that this would be the continuation of the first part. Okay, so the exchange ratio is already derived as 0.20. Post merger EPS would be based on the exchange ratio 0.20. Okay, post merger EPS, total earnings divided by number of shares of the merged firm. So total earnings would be 200 plus 40, that is 240 lakhs. Number of shares, Mark has 20 lakhs, while Mask would be holding as per the exchange ratio in the merged firm 240 lakhs divided by here 2 lakhs, that is 22 lakhs. Answer is 10.9090, 10.90991, rounded up. Okay. What is the third question? Third question is, what is the expected market price per share? Okay. Expected market price, we need to find market price per share of Mark Limited after acquisition. It refers to post-merger MPS, assuming that P ratio remains unchanged. Okay. P ratio is going to remain unchanged. P ratio is equal to MPS divided by E, that is EPS. If P ratio is not going to change, P ratio is the same 10 rupees. What is the MPS if post-merger EPS is 10.91? It would be 109.1, right? Now, fourth question, determine the market value of the merged firm. Okay, we need to find the market value of the merged firm. How market value is derived? Market value is the MPS into number of shares. See, this is going to be of merged firm. Merged firm, MPS we have derived as 109.1. We already know number of shares is 22 lakh, which we calculated of merged firm. So what would be the market value? 109.1 into 22 is equal to 2400.2 lakhs. Okay. Now, calculate the gain loss for shareholders of the two independent companies after acquisition. Fine. We need to calculate the gain or the... See, how we can calculate is market price per share of Mark and Mask. Pre it was 100 here and here it was 20 rupees MPS. Okay. Post we calculated it is 109.1, while the Mask shareholders would be holding at the ratio of 0.20, which would be 21.82. Okay. So there is a gain of rupees 9.1 lakhs and here there is a gain of 21.82 lakhs per share. Okay, per share there is gain. In book it's been calculated as per market value. So if we'll multiply the number of shares, that is 20 lakhs, here 10 lakhs, we'll get the same answer as in the book, 18.2 lakhs, and here 182 lakhs. You can calculate up to this much also. You can also calculate up to this much. This is as per share value. The gain would be this much. Okay. Illustration 13. ABC Limited run and managed by an efficient team that insists on reinvesting 60% of its earning in projects, provides on return on equity of 10% despite the fact that the firm's capitalization rate is 15%. Okay, the firm's current year earning is rupees 10 per share. Okay, so in chapter number 6 part 1 I had shared you regarding the growth and dividend and earning video, where a little bit concepts had been explained. So I would like to recall all those things. If you are not first watch that, and so this would be easy for you. See, growth is equal to B into return on equity. This is retention ratio and this is return on equity. Okay. Now, what is retention ratio? Now, in a firm, there is profit earned. Out of this, some might be retained and some might be paid out as dividend. Okay. So, from net income refers to income after expenses and taxes. Dividend is paid out. Okay. And the ratio which we found is the retention ratio. out of net income dividend after paying out dividend that is retained in the business, and that is known as retention ratio. Now whatever the shareholders are holding and the net income to the equity shareholders, that means net income whatever we are gaining out of the equity shareholders holding, it's known as return on equity. Fine. So this, after multiplying this retention ratio and the return on equity, we get the growth. How much is the growth? Okay. So if this is 1, retention is denoted by B plus dividend payout ratio. That means 1 minus B is equal to dividend payout ratio. Now in question it is said that it is reinvesting. That means it is retaining 60%. Therefore DPR is equal to dividend payout ratio is 40%. Okay. Return on equity is 10%. Capitalization rate is 15%. First question is earnings is 10 rupees per share. It is current earning, that is E1. Okay. At what price the stock? Now these are the given information. If we are asked to find the stock price, we know the formula: dividend cost of capital minus growth. So D1 is earnings into dividend payout ratio. Cost of capital is 15%. Growth is G is equal to B into R. B is 60%. Return on equity is 10%, which is equal to 6% minus 6%. So after calculating, we'll get to the answer 44.44. Now the share price is 44.44. The second question is, what is the present value of growth opportunities? Okay, the company currently is in growth. They are asking what is the present value. We'll consider if there is no growth. Okay, to know the present value of growth opportunities. If this is the stage where there is no growth, after certain stage company is on growth, they are asking what is the value, present value with this and this after comparing. So if we will minus this with this, we'll get to know the present value. Okay, so with no growth, the formula is D1 upon KE, where there is no growth. We are not investing, there is no growth. We are fully paying the earnings. So it is E1 upon KE. That refers to 10 divided by 15%, which is equal to 66.66. Okay. So the present value is this minus no growth. So we get the answer as negative 22.22. Okay. Present value of growth opportunities means what is the growth. If we are having growth opportunities, the price of the share is 44.44. While if there was no growth, the price is 66.66. The value of share has been reduced after this. After the team insisted on reinvesting 60% of its earning. Okay, the value of share is increased in the eyes of investor. Fine. So third question is, why would such a firm be a takeover target? Okay, if the value of share has been reduced, we will buy that firm, and after buying, in the eyes of investor, though the value of share is reduced, we will change its policies. We will change the policy of reinvestment, that is whatever the growth is, and we will bring it to no growth. If suppose we will bring it to no growth, we will pay out full dividend, full earning as dividend, then the value of share is going to rise high, right? So the value of the firm would increase. The maximum value it could go is 66.66. Okay, so this is what it is written.